Very special guest today, Mike. What do you think about this?
I feel great.
Pretty good.
Fellow bald. We don't have enough balds on the show.
That's right. I'm outnumbered, but I'm
Well,
always
you're working on it.
I'm almost where you guys are. I'm
Good, you're almost looking good.
You know that I aspire to that.
It's a 2024 story.
Ladies and gentlemen, Tony Dwyer is in the house. Tony, welcome to the Compounded Friends. You and I have done stuff together, video stuff together. This is the new show that we built as we exited the pandemic, where we said, let's actually get away from the Zooms and see people in the real world. You like
I'm
that?
all in on that.
You are,
I'm
right?
all in on that.
Okay.
Yeah, I needed to see people.
How many days a week are you now reporting somewhere other than your house? What are you doing? What's your work schedule like?
Well, it really hasn't changed. I travel a lot, so it'll probably be a couple days a week. And honestly, I don't know how you can collaborate without being around and seeing other people.
You can't.
As a young person, I got into strategy because I worked with Greg Smith, Ed Yardeni, and initially a guy named Joe Feshbach.
Sure.
And those three guys, I walked into their office because I was at the office, and I told them, listen, I'm a political science major from a small school in upstate New York.
Right.
I don't know anything about what you do, and I'm supposed to recap
Hired.
it. Can you please? Right. I learned. So can you please teach me? I ended up playing basketball with Greg Smith, racquetball and squash with Joe Feshbach, and I would talk to Ed every night.
Where was this? What company?
This was Prudential Securities back in 1987, May of 1987. I got in the game.
Was that related to Prudential?
It was Prudential Securities.
Prudential Beige is B-A-C-H-E.
and then it became. You remember Larry Wachtel?
Yeah, for sure.
Larry Wachtel was the guy that taught me how to communicate about the market.
I'm so glad you just brought his name up. I want to ask you. I want to ask you a Feshbach question in a minute. Larry Wachtel had a hotline on his desk for brokers, Prudential brokers, and like anybody who was selling securities for the firm could just call him. And
Correct.
All right, I worked for a guy.
Buddy, I answered that phone.
Okay, but
I got a story for you when you're done.
All right, hold on. I worked for a guy. We were like some bullshit brokerage firm in Manhattan, but the principal of the firm came from Prudential. And so he just kept Larry Wachtel's number.
Yeah.
This is 5 years after he left. He would just, like when the market was acting strange or whatever, he'd be like, let me see what's going on. He'd go on speakerphone with like 5 of us in his office and call Larry. And Larry would deliver this 30-minute, I swear to God, soliloquy. Is it monologue or soliloquy?
Monologue. I don't know. It's whatever you want.
You know Shakespeare?
I think soliloquy works there.
It's a monologue.
Well, no. A monologue is something you speak out loud. The soliloquy is something in the character's head. And they speak it aloud, but it's meant to, all right, it doesn't matter.
Sounds right.
He would do 30 minutes of bullshit, like the rates and Europe, and it was like almost a recording, except it wasn't. He really did that for anybody that called. He didn't even look at whose inbound number this is.
So I got time for a couple stories, right?
Yeah,
So,
please.
So
He was
how
a
did I
machine.
ever get?
Wachtel
How
was
did
a
a guy
machine.
like me ever get on TV?
Yeah.
Right? I didn't go to B school. I
Six
didn't
pack,
study
six
it.
pack abs, same as me.
Same as I got now, right
right.
underneath the rest of it.
Right.
So anyway, I'm one of the few people that would answer Larry's phone because brokers would literally call him up and say, "How do I turn on the computer?" It was when it was just green and white stuff on the computer.
By the way, for the listeners, Larry Wachtel was the chief investment strategist. Right?
No.
What was he?
You know what Larry was? He was the head
of research?
No, he was a reporter.
What do you mean?
Larry was officially a reporter at Prudential Securities.
What does that
and
mean?
He reported the news as it came out and he then interpreted the news better than anybody else before then or after.
Sounds like a one-man
So
Twitter
you guys
feed.
got on. So I'm going to give you this
Go.
is an interesting. I love this.
Yeah.
So nobody wanted to answer his phone because they're answering questions like, how do I turn on the computer? Like, how do you print something? Right? And Larry would do his best to tell him. And Larry had this great thing. Like if somebody called up, he would end the call as soon as they said okay. He was the most gracious man on Wall Street.
Yeah.
And he would, as soon as somebody said, you know how we say, I like XYZ,
Right.
and okay, and he would hang up the phone as soon as he heard the word okay. And you would hear their next question as the phone is on.
Right. Because the phone never stopped
So
ringing.
I got on television because Larry Wachtel was the only guy at Financial News Network, FNN, that was on television other than the anchors at the time. And I used to always bust his chops. I think his son Phil would laugh. I would bust his chops and say, Larry, come on, old guy. Let the young guy in.
Yeah.
Right? I'm picking – and because I picked up his phone and worked harder than anybody else, when he had knee surgery and he couldn't go up the stairs at FNN, he said, give the kid a shot.
Okay. And you must have killed it.
It was a disaster.
Oh,
Well, I was told at the time,
Yeah.
that they're just going to ask you about the market.
Yeah.
And I'm this punk kid that shouldn't have been on TV.
Yeah, sounds familiar.
And he said, and they asked the question, how does the movement in the German Bund affect the future for the 2-year T-bill?
And you had a good answer for that?
I have the same answer that I have with you guys now. I don't know.
And they appreciated that?
I said, I don't know, but this is what's important now.
Oh, so I did the opposite. I made an appearance, like my 3rd appearance on TV ever. You get into the database, and Erin Burnett on CNN?
Oh, yeah, of course.
So she was on CNBC.
Yeah, I remember.
And they're like, Josh, we're really desperate. It's like a Friday afternoon. They're like, some shit just went down with Boeing or Airbus or whatever. And we got to do a segment on it. Do you know anything about and I'm like, no. But I mean, I could do some research and just say I'm not an expert on this, but this is, so that they're like, okay, it's okay. So I do it, and the first question Erin Burnett asked me is about a forward fuselage. But I'm very on. I'm just like, I don't really know about this, but here's this other thing that I do know about that might be interesting to the audience.
That's what I did.
And that's okay.
That's what we're supposed to do, bro. We're not supposed to make stuff up.
That's right.
So another Larry Wachtellism on when Casual Fridays became a thing, people would say, Larry, how come you always dress up on Fridays?
What is this, late 90s?
Yeah.
Okay.
Or no, early 90s. They would
90s.
say, Larry, why don't you ever dress down? It's okay to dress down. He goes, there's nothing casual about running other people's money.
Oh, I love that.
So I learned.
You hear that, you son of a bitch?
I learned in this business from the greatest strategists ever. I mean, think about that. Greg Smith, Ed Yardeni, and Joe Feshbach. And then after he left, it became Akinpour.
Yeah,
I learned from them, but then I got to learn how to communicate it.
Wait, Tony, before you go there, but Wachtel didn't retire with the title reporter. Did he eventually become the strategist?
He
was an analyst. He was never the strategist. He was never a strategist.
He could have been, for all intents and purposes.
He was absolutely the best. He knew how to communicate.
Yeah.
What was going. It's how I learned. It's the blessing that I got.
Was he in the Barron's Roundtable?
No.
Okay.
I believe he went one time on Ruckhauser.
Okay.
And what we did is we developed at the time that it was called the Equity Focus Group, because I didn't know which way I was going to take my career. I knew that I loved the strategy stuff. And the Equity Focus Group there that I built from the ground up ended up with guys like Bill Meehan, if you remember Bill Meehan, who died in 9/11.
Yes.
I hired Bill because what we wanted to do was communicate and coordinate what the strategy group was saying to the financial advisors so they could tie together with what the research department liked.
Bill Meehan is the guy that Barry Ritholtz on 9/11, I think this is accurate, was emailing back and forth with or something that morning?
All were.
Okay, because Barry was doing a column at thestreet.com.
Yeah.
And I'll ask Barry this story.
I was doing the street.com column at that time too, and Bill was, he was in the towers.
Shitty story. All right, so my Feshbach question is he related to the Feshbach brothers? Or that was its own thing?
I think they're cousins, but I don't remember. I'll ask him because I'm still in touch with them every now.
And they were like the notorious short sellers.
Yeah, they're like old school short sellers. Press it and then press it and press it and press it.
Yeah.
They were.
They're not still at it.
I don't know. It was.
It's so long ago.
This may shock you. I tend to be on the optimistic side. I don't know how you wake up bitter every day.
Yeah.
So I didn't really follow them as
Big
much.
beat for Disney. There we go.
All right, so
that was fun. Thank you for the memories,
dude. So learning how to communicate is important. I'm of the opinion. I've said this before. We're not in a math business. If it was as simple as figure out the formula, it would have been figured out. Mm-hmm. We're in a communicate.
Yeah.
At every level.
Every level.
The Fed is in the communications business.
Big time.
Right. It doesn't take a lot of effort to push the button to go from 25 to 50 basis points. All of the effort is in how they explain it and phrase it and how they get you prepared for it and how they decide to reverse themselves when they have to. It's communications business. Every firm on Wall Street, same business. Sell-side research is communicating with clients.
Has to be.
And on and on. Asset management, fund management. Most people buy stories, don't buy equations. Even the quants are telling the story of why their factors are going to beat the other guy's factors down the street. So I feel as though this is the ultimate communications business. And obviously the analog for that with what we're doing
Thank
God, because I'm not that bright.
Morgan,
I can communicate it because I'm not that
Morgan
bright.
Housel says best story wins. It's true.
You agree with that?
No, I agree with good guys don't finish last.
Yeah.
Full stop. And I also agree with the best way to communicate a story with integrity and honesty is what wins. You have to be, I believe you have to be a likable person. Clients don't want to meet with somebody that offends them or is not, or demeans them.
That's why I don't have clients.
Right? It's you haven't offended me. So, but it's any business. We love to make this about us. It's not about us. Yeah. My brother's an orthopedic surgeon. He's a salesman. He's got to sell to the hospital. He's got to sell against the other orthopedic surgeons in the area. He's got a marketing.
Right. What he's selling is the certainty that he'll know what to do.
Yeah. And that's what we do, right?
Like we did the MRI. We determined the best course of action is surgery. When I open you up, we don't know how things are going to go. You have to believe in me that I'm going to get you out of this and it's going to work out.
I've watched people that have never been in business, have never done the job that they're tasked with. I told you about my family business that the kids have.
Yeah,
I've watched people on
family business.
We're not even good Irish mafia. Right. All right. But the bottom line is, it's never what's on paper. It's always about how you can communicate your true identity and how you go about it. I always say on TV, it annoys the hell out of some anchors. My job isn't to be right or wrong or tell you what to do. It is inappropriate for me to tell somebody that I've never met, have no idea their risk tolerance or financial condition. It's inappropriate for me to get on there and say, do this. That's right. Right? I don't know what that is.
It's like a child. All right.
You get the buttons too.
We're upvoting you. We agree with that.
Him.
So no, I believe that with all my soul. 100%. So I will never go on and I tell my subscribers, I tell you guys.
Your job is to say this is what's going on. This is what I think it means.
Has meant before.
This is what we're telling the professional investors that are relying on us for research and opinion.
Correct.
But then listen, you don't know all 1 million people that are watching you in that moment. How could you possibly?
Right.
So everyone has to have responsibility for their own actions as a result of this information they're getting. Your responsibility is to have the actual facts and to have thought enough about those facts that you can say something intelligent.
It's creating a story,
yeah,
Josh.
I agree.
The PowerPoint I sent you for the show. If you'll notice on the PowerPoint, there's a core thesis, and around that core thesis, you tell a story. You put together a mosaic.
Yeah.
And what the mosaic should say. Now, so 3 weeks ago, market's getting smoked. Less than 10% of the S&P is above the 10-day for 10% for 5 days in a row.
Washout.
So and when that's happened in the past, you get a pretty snappy reflex rally, right?
RSI was 8. 8.
It's the stochastic, the whole thing. Right?
Yeah.
It's there.
Yeah.
So you know it's going to bounce. So then the question comes to me, and it's why I stopped doing it. Question comes to me, do you buy them here?
Oh, yeah, always. Right.
I don't know. What's your time frame? Are they going to go up from here in a reflex rally? Uh-huh.
Yeah.
I think so.
And then what?
But do you buy them here?
Right.
I have no idea.
Yeah.
Because I'm not going to tell you that it won't retest that low. And if you buy them here and it breaks that low, and you said, hey, you told me to buy them here,
Well, this is the other problem, and I don't want to dwell too much on this, but I remember specifically in either June or July of 2020, after markets had staged that furious comeback, and then they were getting the commentary from Druck and from some of the arguably some of the best investors of all time,
Tepper,
right? Tepper, where it's like, this is not where you buy them, it's over, whatever, and that's okay. They have the right to have that opinion. They could have been right. In hindsight, we know they weren't. But my point was, they're like, Josh, you're telling people to buy or to stay the course, but Stanley Druckenmiller said this. And I just said very simply, here's the thing. Those are two of the greatest traders of all time. They're in the pantheon, right?
Mm-hmm.
Stipulated.
Sure.
And I'm not. But the reason they became the greatest of all time is that they can reverse their opinion 180
Correct.
degrees in 5 seconds.
And they probably did.
And will put billions of dollars behind that reversed opinion. And they've done it in the past. Mm-hmm. And they probably did in the summer or fall of 2020. They're not going to call you.
That's right.
So if you take the bearish commentary from them and utilize that, you may not get the phone call. You probably won't. Druck's not calling you. That concept, I think, is lost on a lot of people.
That's right.
When they're taking the commentary of somebody, thinking it's personal advice for them, and then they get mad because that person changed their mind. Hey, you didn't say, dude, How much did you pay me? $0?
Is
One of the
Druck
reasons I like
Druck
you
on
guys-
Patreon? Druck's on Patreon, I think.
One of the reasons I like you guys, I know,
Cameo.
we could be silly.
You could get
this
him
is
to-
a serious topic.
Yeah.
And the seriousness of this topic is, like Larry Wachtel said, it's not a game. It's not a game managing other people's money.
No.
And when people do that and they say, you're right, please, for the love of God, don't listen to somebody like me at a data point and not watch the show I'm on or the website I'm on. You got to follow along. Like Druck, he's even said, I made a huge mistake there, but I reversed it quickly. If you didn't, like you said, Josh, if you don't follow that, he's not calling
Well, that's
you.
the other thing. That's the other thing.
We're a data point.
Tony Robbins spent like a few months pretending to be a financial advisor. He wrote a book for regular people, like how to invest for retirement. And I think he's well intentioned. I mean, I think he was trying to do a good book. So he calls his best friends. He calls Ray Dalio. and he's asking guys that made their money running the most successful hedge funds ever, like, what financial planning advice could you give the readers of my book who have $30,000 in an IRA? And the whole thing is obviously ridiculous. So I think that's another thing that people get wrong.
Yeah.
You listen to Jeff Gundlach, macro commentary. No offense, you're not Jeff Gundlach. You're not running $120 billion in bonds. The shit he's saying may not apply to your 401k. Can you just watch and learn and not act on it?
Use it as a data point.
So then he's bearish. Obviously, he's selling fixed income and he's wrong. And people are like, oh, Gundlach screwed me up. I got out of stocks because I was listening to him. Dude, when you're painting your house, are you like trying to emulate Michelangelo? Because you guys are not doing the same thing.
Can I take a minute to explain where this thing can go sideways? And you know this, but I think it's important for the listeners and viewers of this. Okay. The problem with listening to somebody, taking their input and taking an action is you have no true conviction in that action.
You just believe in that person.
Right. So when it goes against you, you tend to do the wrong thing. So how do you panic into a whoosh when 5 days in a row you got single digits of the S&P above their 10-day moving average? Because you don't have any conviction. It's not your data. Yeah. I always urge people to, if you're going to do it yourself, make sure you come up with your own process. Don't use Josh's or Tony or Michael's process.
Or
use
worse,
your own, because that way you know what to do when it's going sideways.
Or worse, don't switch your guru each day based on the last opinion you heard.
Because none of us are. Well, that's the full stop fact.
Even if you think somebody literally can predict the future reliably, even if you believe that, don't switch which person you're listening to.
That's right.
But you know what? The problem is you can tell somebody a million times every single day, don't listen to me on TV, don't listen to me on TV. I'm just a person. I've had this conversation with family members, the same family member, 100 times about what Josh said. I said, I love Josh. He's very smart, very charismatic, and knows, but don't listen to him on a day-to-day basis for stocks. And it doesn't get through to these people. And it's not just one family member. There's multiple people. They don't believe that. They don't believe that the people don't know.
Where's it come around to? The same thing we started out with. Who could tell a good story?
That's it.
Who can get the mosaic?
Well, people want to be told. People want to be told what to do.
I used to buy.
I mean, we think we don't, but we do.
I used to buy Barron's for the round table, the stock picks in the round table. I loved it. Like, this is when I'm like 22, 23. I'm in the business. I don't know anything. And I think like this is what you're supposed to do. And like Abby Joseph Cohen would be quoted in the round table, and she was great, like no disrespect. And her equity ideas were not hers. Goldman Sachs has 500 analysts, and they take the best ideas, filter it up to her so she can make her appearance and say the stock ideas. And I would buy them, and they would invariably go down. Not because of anything she did wrong. No, it's just the nature of the market.
So I go up to Feshback's.
And it's like, I thought she was a genius.
She is a genius.
She is a genius, but not at that.
So I go into Feshback's office. It was Barron's. On the cover of Barron's was Upjohn. And they had come out with minoxidil. Michael, you know what minoxidil is, right?
What is that, a pharmaceutical company?
No, it's the stuff for
Rogaine.
baldness. It's Rogaine.
Yeah.
Right? So I'm like, I go up and I bought it. I bought options on it because I'm an idiot.
I thought you bought the solution.
Well, I did too. And it worked well. So I go up, I go up to his office and I put the cover of Barron's on his desk, right? I'm learning. I told him I didn't know.
Yeah.
I put the cover of Barron's on his desk with Upjohn. I go, it's in Barron's. It's a great story, and I'm already losing money. I think I should buy more. And he looks at me and he goes, why would you ever throw good money after bad money?
Yeah.
And he could have told me that 50 billion times, and it wasn't until I lost enough in the options market to pay for
what makes it bad money? That the stock went down?
It kept going down and it kept going down. It had good news. It peaked on good news and it started to go down. Yeah. And of course, I bought the wrong vehicle, even if it
which is another way in which stocks break your brain, peaking on good news.
That's right.
But all right, I want to get into your stuff here.
Yeah.
So you mentioned your thesis. So far, you're spot on. So I'll spot you. It's been a month and a week, but still, you're spot on for 22. I want to just recite a piece of your core thesis, and then you're going to tell us the rest.
Okay.
Core inflation remains historically high. You wrote this in December?
Yep.
Okay. The highest level of core inflation in generations should continue to reinforce the Fed's more hawkish tone. They have only got more hawkish since you said that, and plan to wind down the balance sheet. There are two items that appear hopeful on inflation. Year-over-year change in unit labor costs, and what's the other one?
The other one is the 10-year inflation break-evens, the market-based inflation break-even.
All right, let's do one at a time. And John, if you would, throw up the non-farm unit labor core PCE versus non-farm unit labor costs.
Chart on.
Now, just keep in mind, most of our audience is not Larry Wachtel.
Well, the great thing about Larry is he simplified it, and that hopefully is my gift.
All right, do that.
So what you see in front of you is the blue line is the core PCE.
That's the Fed's preferred inflation measure.
That's what they stated they use. Okay. I love people say, why don't use the CPI or what about this? I use what the guys printing the money tell me to use. I don't try and outthink it. So
why do they use this? What does it take out?
It has a lower it has a lower percentage of owner's equivalent rent. It's the same makeup. It's basically it. Okay. So in other words, owner's equivalent rent or the cost of housing is a much bigger percentage in the CPI than it is the core in the PCE.
Okay.
No, and both of them have a core which excludes food and energy. The blue line is showing you the core PCE, core inflation based on the one the Fed uses. The red line is unit labor costs, non-farm unit labor costs. Now, according to my friend Chris Lowe, because again, I'm not that bright. I know a lot of bright people. My friend Chris Lowe, reinforced to me that that red line, unit labor cost, is a broader measure than average hourly earnings. So that's the better one to use. So my friends at Ned Davis, where I get most of my charts, they show that there's a correlation coefficient of 0.87. And so in English, that means they move together.
Yeah, it's a little noisier. The red line is a little noisier than the blue line, but they end up in the same place.
But they end up in the same place. And what you'll notice is the red line's been going down for 3 or 4 months on a year-over-year basis. Okay. Right? So that suggests that core inflation, which is a year-over-year indicator, should begin to turn down at some time in the spring. So what we have, guys, is the Fed in a box. I do videos and written stuff. The Fed's in a box because current inflation, they got two things, inflation and unemployment. Inflation's way too hot on current, and unemployment is way too low. They have to raise rates in March. They said they're going to do it. The market is ahead of them, frankly.
Yeah.
Right? But
the market raised rates 4 times. The 2-year Treasury is what, 1.25 at least.
At least 4. Yeah. Like if you look at the Fed funds futures versus the dot plot, it's much more aggressive on the Fed funds futures, which is why our call for long-term rates. This chart plus the next one, which is the 10-year inflation break-evens, which is the market-based inflation expectations. If you ask me to explain it perfectly, I can't. My kids have a funny thing in their business. If you don't know the answer, Google it. Right. So if you want a description of it, Google it.
John, give us U.S. break-even 10-year.
How accurate are break-even expectations? Are inflation expectations?
They change dramatically, just like Fed policy.
So how often does this actually predict future inflation?
Well, let's just look at the chart. I'm not worried about its predictability. I look at where it is relative to where it's ever been. So guys, every recession in my career has been from a unique reason. Savings and loan crisis, Saddam Hussein invades Kuwait, right? Early 1990. Yeah. Then you had the dot-com, but that wasn't the recession. The recession was 9/11, the global shutdown that came from a credit crisis, WorldCom, the various.
You don't think the NASDAQ crash alone was putting us in a recession because all that Y2K spending dropped off a cliff?
It definitely helped it for 100%.
And then Enron, WorldCom, and then 9/11.
It was the
like
credit
a
crisis.
triple whammy.
It was everything.
Yeah.
And the globe was weakening pretty hard too. Remember, commodities
Russian ruble,
were still low.
Asian contagion.
That was
long-term
97
capital.
and 98.
But I'm saying there's a contributor.
It all goes into it. Recessions don't happen on a dime. I was on Fast Money, I think it was in, I know what day, August 26th of 2019. And I was on there because they had their graphic, which I never get input on, was the Dwyer's doomsday clock, which is pretty rare for me because I tend to be an optimist. And it was because the yield curve.
You should have your head explode on the graphic.
It was exploding. Right. Anyway, so the bottom line is it takes a while for recession. So we had that one. Then we had the great financial crisis and, of course, the pandemic. Always a unique reason to go into recession. What's the answer for the recession? What's the solution every time?
Low rates.
Print as much money as you can.
Spend it,
As much money. So the human nature behavior of the market coming out of the recession should be somewhat consistent. More extreme each time because the amount of printing.
Oh, that's
but
interesting.
somewhat consistent.
The reaction to the recovery should be consistent, even if the reason for the recession is wildly inconsistent.
So let's look at that chart that we had on the 10-year inflation break even. And the point that I'm making is in this chart is that the U.S. inflation 10-year weekly graph, when you look at the peak, that horizontal blue line, it's what happened coming out of .com. It's what happened coming out of the great financial crisis, and it hasn't surpassed those levels, and it stayed there.
Okay.
So the unit labor cost and the inflation break-evens are suggesting the opposite of what too many people like me are saying, that the Fed's behind the curve. The two data points that have excellent accuracy over time are suggesting that the market believes the Fed.
Yeah.
That the Fed is going to get a hold on this thing.
Right. But then the question is, how many rate hikes do they need to get a hold of this thing? That's where the discrepancy comes in.
And do they go too far?
So here, awesome. That's why I love these shows. I can actually explain stuff.
You have 30 seconds.
It's never the absolute level, right? Right.
Take us to commercial.
Hold on, I hear the music. So the number one question I'm getting now, and I always get at this point in the cycle, is what's the level of rates that's going to shut it down or create a problem? And in my experience, it's never the level of rates. It's whatever the rate is to invert and flatten the curve and shut down financial conditions.
And the Fed won't do that deliberately.
No. So like for now.
How could they?
They do it every time because the 10-year trades below where they ever think it will.
But they don't do it deliberately. It just happens.
It just happens.
Yeah.
Because they raise rates, and then what happens is the 10-year trades below it. And remember, the yield curve in English, this is where I love to be able to do this. In English, the yield curve simply means what is a lending or investing institution getting their money at? And what return do they get by investing it or lending it? So if a bank is getting their money at 0%, and they're lending it at 2%, that's the same difference at getting their money at 4% and lending it at 6%. It's 200 basis points. When that inverts, why would a bank ever lend money to lose money? So what happens is the long-term inflation outlook gets better as they're raising rates.
Why would a bank pay 400 basis points on deposits and lend money at 200 basis?
Of course they wouldn't.
Never happen.
That would never happen.
Which is what shuts down the economy.
That's what shuts down money movement. Here's the problem. I've got a chart that I sent you guys that looks at the long-term Fed funds rate. Okay?
Which one is that?
It's from the Philadelphia Fed or St. Louis Fed, one of the two.
Is this the Fed is about to embark on a tightening cycle?
No. So here's this chart is the Fed funds rate.
I love this.
The overnight rate. And what you see every cycle is a lower peak. I wish I could get up and point to the chart.
No, I got it.
Because
in 2018, we peaked at 2.5% Fed funds rate before they had to start cutting again.
So I hope you remember this. I'm sure I was doing a show with you around it. In 2019, when Jerome Powell, 2018, when Jerome Powell said we're nowhere near neutral.
Yeah, that scared the shit out of everybody.
It scared the shit out of it. My next report was the next rate move is going to be a cut.
Yeah.
Because you were bouncing that line up against what the downtrend line. So why is each peak of the Fed funds rate at a lower level? And the answer is because there's so much debt. If your solution to a recession is to print more money, an excessive amount of money, I can afford this. I'm making numbers up. I can afford $1 million house at 3%, right? I can afford maybe even $1 million house at 4%. I cannot afford $1.5 million house at 4%. So what happens is when you throw so much money at it, what do you do with the money? You invest it.
Yeah.
What happens with that money when you invest it? It lifts the asset price. So what people like me rarely do is talk about to turn over and create that economic activity. You have to turn over money. But there's going to be a point where people can't afford that $1.5 million house at 4%.
Yeah.
The only way you can afford a higher priced house and a higher interest rates is if you get some magic money coming in from your income, which doesn't happen.
Yeah.
Or you have lower interest rates.
So to your point, we have never, or maybe once, it looks like maybe once, we've never, other than one time right around the year 2000, we have not had the peak in Fed funds rates eclipse the prior peak coming out of the previous recession.
That is correct, since 1982.
Right. But so this thing between 1995 and 2000 is a little bit aberrant because they never really.
So here's an interesting thing.
That last cut was 98 during the Asian crisis.
Yeah,
and it had nothing to do with our economy.
Well, in 1995, what most people don't know, I love the market history. 1995, the first 2 quarters of GDP as reported were 0.5% growth. So if a recession is negative growth 2 quarters in a row, 0.5% growth.
Yeah.
Right. So that 1994 move in credit, that high spike in yields, that shut down credit. And that was one of the worst internal bear markets. It was last year, basically, for a lot of stocks. You had an internal bear market that ended up with almost a recession. It was close to recession. So I would say, Josh, on that 1994 move and 95 to 98. It
was also a surprise. He was doing intermeeting moves, Greenspan, in 94.
We were just talking about that. That put Michael Steinhardt out of business, the 94 surprise rate hike.
It was brutal.
It was worse for the bond guys than for stock guys.
It always is. So bond guys, how about this one? If you look at the 20-day rate of change on the high yield index, yield to worst, the only time I can find outside a recession it was as sharp as just now
is 94?
Is 2013 and then back to 90.
The
taper
tantrum did the same kind of thing.
All right.
What do you think about, we got some data yesterday that the Manheim, which is a hilarious name for the used car price index, is finally flattening out. First time we had like a month-over-month change that was flat in
like a year. It did it last year too. It did it last year. So last March and April you had this massive ramp in rates. Right, because that's when I shifted my market opinion because you had such a sharp move in rate expectations, and it was based a lot on the Manheim index and its impact on the consumer price index. Right, so then it came down because it's a year-over-year calc, and then they gave out more stimulus. When you give people, we're going to be in an economic transition that goes from buying stuff to doing stuff.
Yeah.
Right? When you give people trillions of dollars.
Goods to services.
And you don't let them go anywhere, they're going to buy stuff.
That's right.
And that's what they did. So there's a chart that I have that I sent you guys. It's the one that looks at the makeup of GDP between goods and services. You had a spike in goods coming off of the pandemic low to a degree that I don't think you ever have. This one right here. So the top third of that chart is durable goods as a percentage of total personal consumption.
Holy shit, look at that spike.
You've never seen, but it's also pulled back, okay?
What's in that? It's cars.
It's durable goods,
microwave
stuff
ovens,
anything, washing machines,
wood chippers,
all that stuff.
Things that go on a ship, that get shipped to us.
So that's it went from like 8 to 13% of economic activity. Now,
and that shows up heavily in these inflation data calculations.
But the bigger one is services never go down.
Not like that.
But wait,
not
before
like
we even
that.
get services, this assumption that everyone who bought a used car and a dishwasher last year is also going to buy one this year.
Right.
That's not how this shit works,
buddy. So I got another chart, that, John. I brought a lot of charts. So there's another one that I have that's wholesale inventories hit a record. So if you want 10 widgets and you're in a supply chain constraint and the demand is extraordinary because of all the free money, what do? If you want 10 widgets, you order 20.
Double ordering.
Yep.
So the fourth quarter inventories
a never before seen level
yeah.
of inventory build, which is led by 5 months by goods orders, right? If you're gonna, so that turned down about 3 or 4 months ago. So that's suggesting that inventories are going to be depleted. It's also what happened in 2005, 2011. So I think what we're doing is replicating the economic movement because the solution was the same. Of course, it'll be different to some degree, but it's a similar type of thing. So what's going to happen is we're in this transition where inventories are being depleted, which means you're producing less. So goods is down. ISM is coming down from the Institute of Supply Management, has peaked and coming down from the 60s. We're going to produce a lot less. We got enough. We overordered. The transition from that buying stuff to doing stuff.
That's the services number.
Yeah.
John, go back one.
That's it right there.
And to Michael's point, that number never falls.
Never.
So when it did, the only way that could happen is it was forced to.
It was forced to. So thank God, because if you think inflation's bad now, imagine in services along with goods.
Ben and I were just talking about the fact that a lot of this pull forward stuff might have been really bad for a lot of businesses that we thought was good at the time, like Zoom, for example, and Peloton and Robinhood, and all of these numbers that were so distorted that made comps absolutely barbaric, like just impossible.
Yeah.
I think crushed a lot of these companies.
It's going to, part of the issue is going to be to manage inventory depletion because you rushed out to get enough stuff to create stuff where your demand's going to weaken because I want to go on a trip. I don't want to buy another snowmobile, right? I want to go somewhere.
Yeah,
I've had enough of looking at the house.
Everyone bought a boat. Everyone bought a jet ski. Everybody bought motorcycle, patio furniture, stuff for their backyard. Everyone did that. Let's assume.
Correct.
The next step is not more of that.
Right. How many unless you want to know
why the travel stocks act so well right now, I think.
I mean we've got a wedding to go to in Spain and I can't wait. We're going to probably do a cruise. We're going to do a lot of stuff.
But bring your snowblower. So all right,
so what you see in this chart is you've got a massive spike in inventories, and look at in 2011 what happened. You came down. Look at in 2005 you came down from peak. You build inventories when there's finally demand after a recession. If the solution is the same, the human nature reaction. Some people think that companies are somehow different than everybody. No, it's a guy or a gal running the company.
Yeah, it's a CFO.
It's right.
Person.
So they're getting stuff because they got to make it. They got it because they finally got demand.
Tony, what are Joe Biden's economic advisors telling him exactly what you just said? Like what's the guy's name? Jared Bernstein or whatever?
No, that's the old guy. I don't think. Is he the guy now?
I think he's back. Whoever so Biden is probably every night he goes home, these goddamn inflation numbers, everyone hates me. And then he's got a chief economist or whatever, national economic advisor, who's probably saying to him, no, you don't understand. The leading indicators are telling us inflation is about to drop off a cliff.
It doesn't matter to him. Basically, here's the problem. You've got really high inflation. It's all anybody's talking about or caring about. So here to me, the risk isn't monetary. The market has already priced in more Fed rate hikes than the Fed is predicting. It's already there. Right. To me, the issue is, does the president try to do something to fix it?
What?
You've
Price
got
controls?
terrible polling numbers. So there's a history of that when you're in a midterm election year with a first-term president and the numbers aren't great and inflation's a problem. You got to quote unquote do something. And that creates it could be geopolitical, it could be price controls. JFK did it with steel prices back in 1962, where he got into a very public battle with the CEO of U.S. Steel.
Well, he just did something stupid that already didn't work with the Strategic Petroleum Reserve. What did he do? He sold barrels out of it, and then the price immediately went higher.
It always happens
so
that way. It's like
so he already
trying to manage the currency. It doesn't work.
Yeah.
You can't.
Right.
It's an open free market.
Right.
So they're not going to be able to do it. So to me, the risk is in the upcoming maybe dock workers negotiation on the West Coast. I'm told in April.
Cruises and airlines are on fire.
Because Omicron has crested.
Casinos.
And now to your point, people want to go do stuff.
You're going to go do stuff. So that economic transition creates a soft spot.
Yeah.
Right. So we're in that soft spot. So you got a Fed in a box going back to
how long does that transition take between goods calming down and services ramping up? Is that 1 quarter?
I think my call is it's by the first half. It's the first half. It's why I was not defensive. I was looking for a tumultuous year as you started the show out because of that Fed uncertainty and economic transition. I'm thinking first half.
Hold on, before we get that, you know what hit an all-time high today? All-time high. Marriott.
Did it really? Wow.
Makes perfect sense. I want to go back to your comments. This is back to you. Earnings per share direction should remain positive. The market correlates with the direction of EPS, which should remain soundly positive over coming quarters, despite the impact of higher costs, economic transition, and an uneven global economy. Margins peak when the top line falls, not when costs go up from macro perspective. Okay, most people think it's the opposite. Right. Most people look at rising costs of labor, rising costs of commodities, and they say margins are about to peak. You're saying that's not actually how that works.
No, because you can always pass it through.
Always? Every industry or just
no,
generally?
no. That's a macro. So if you look at S&P 500 earnings, like people like me do, and you say, okay, costs are going up, that means margins are going to weaken and earnings are coming down. It doesn't happen that way.
Margins are at record highs.
Last quarter, market margins hit a record high. So why we're even debating it publicly is beyond me, because that answers the question.
Chipotle's got 3 price hikes since the pandemic started.
Right.
They did one in December. They're putting through another one. They put through another one in January.
Okay, so this is the chart which you can see. It's S&P 500 operating margin against the unemployment rate inverted.
See how they keep that margin at all costs, pretty much.
So,
but then what happens? So what changes it? What changes it is you lose your job or you lose your credit, right? So when credit starts to tighten up, well, at least I'm working. And then when you're not working, you don't have any money to do anything, and so margins tighten up, right? They start to come down.
Because people are spending less.
They're spending less. You can pass through the cost when you have cost increases, but you can't fix revenue when it's dropping.
I gave this example before. Either the CEO of Lennar or Pulte or one of the home builders, they raised prices, obviously, when the cost of everything went up. And when lumber crashed for a second, they said, now that cost of lumber came down, are you lowering your prices? And what did they say? We're taking it to margin.
Right.
Yeah. We're keeping it for our trouble.
So by the way, Chipotle.
Well, look at a bank. A bank is pretty slow, and when rates come down, they're slow in lowering.
Look at a gas station. How fucking fast does that price per gallon go up with the price of oil?
Before the gas goes up.
And then the price of oil collapses, and it's like 3 weeks before you see that at the pump.
And it hurts the exact wrong people. Like this whole idea, unfortunately, the lack of investment in energy is obviously a problem, right? Because you still need a lot of gas. The problem is if you look at the percentage, if you look at the bottom quintiles of income, it's about 10%. Your gas usage per household per year is roughly a little under 10% for the second lowest quintile of income. For the top quintile, it's like 1.4.
Yeah.
And this is why
it's the ultimate regressive cost.
It's the worst.
Yeah.
And this is why asset owners do well. UPS, on their last earnings call, announced the biggest dividend increase of all time.
I want to ask you about...
it's such a big deal that we don't talk enough about.
I want to ask you about valuation. So this is you. The combination of strong earnings growth and correction in the market has allowed valuations to become more attractive, similar to what took place in 2010, 2011. I think the S&P PE multiple in 2011 was like 12.
Right.
I mean, this is obviously
it's different. It's different, but interest rates were different too. The point of this chart is that people keep.
Are we on the right chart?
Yeah. So people keep talking about how this is like 2000, and no question, you got concentration of market. But frankly, it was much worse in the early 1970s than it was in 2000. Let me give you a history lesson on 2000 because it was painful. So in the last quarter, I almost got. I don't want to say fired, but I almost got fired because I wrote a report called "Cash is King, Please Raise Cash." That was the title of the report.
Yeah, nobody makes money from that report.
No, and I almost got fired.
Mr. Dwyer, put that back in your drawer.
And it was like 30, and the market went up 30%. So the NASDAQ composite went up almost 50% in the fourth quarter of 1999.
Yeah, I remember.
It didn't do that in the fourth quarter of last year, just to be clear.
Yeah.
Then it went down, and it began the year with an 11.8% drop. And then guess how much it went up into the peak by March? Another 35%.
Yeah.
Right? And then another thing that people don't realize is in 2000, you peaked everybody talks about March of 2000, and that was the price
peak. That was the NASDAQ peak.
By August,
yeah,
you almost broke into a new high territory in the S&P. The NASDAQ obviously didn't get up, but it still bounced. So our view is that valuations are contracting like they did in 2010 and 2011 because earnings are going up so much faster than the market.
We're all calling this the re-rating, but you're saying the E in PE is still growing.
Totally.
Which is why the multiple is coming down even faster than it otherwise would.
The multiple came down last year.
Where do you have the multiple? Where do you have the next 4 quarter PE ratio right now?
I use 20 now. I use 20 because that's the average PE when core inflation is between 1% and 3%. And I believe that core inflation will drop to below 3%.
You're saying that's where we're currently valued?
That's where I think fair value is because that's the average.
So where are we though in real life?
I think it's like 18. What is it now?
So
I'm at 225 divided by 18 or 19. I don't even know.
So we've overcorrected already in multiples.
Hold on. Let me do this so I don't make a mistake on such a big podcast.
While you're crunching that, John, throw up this demographic tailwind. I talk about this all the time.
I don't 20 times, so it's right around fair value, plus or minus.
Okay, so I don't specifically believe that anybody can look at demographics and divine a market opinion from them. And I've also seen two people take the same data and come up with the opposite. So like Harry Dent Jr. says demographics are destiny and we're fucked to look at all these boomers.
What does Harry Dent Sr. say?
And then Tom Lee says the same data. He says, no, actually, we have a boom in 30-year-olds, 31-year-olds, 32-year-olds.
Tom's right about
this is the household formation boom that we've been waiting for since the year 2000.
Yep.
It seems that you're in the same camp.
I've been using this chart for the last 6 years in my picture book.
Okay.
And here's why.
Well,
when did you get married?
Tell people
what
who are
age
listening.
did you get married?
20. Shit. Shari, if you're listening, I love you. 2003. I was born in 77. How old was I? 28?
Okay. Michael?
Close enough. I was 20. I was actually 28.
All right. 26. I was 28, right?
I was 26.
So when is your house? When you get married? I met Patty. I love you, Patty, when you listen.
Yeah.
I met Patty when I was 27. Got married at 28. First son at 29. Second one at 30. Out to the burbs I go with a big SUV.
Oh, we're giving shout out to our wives. Robin, whatever.
Right. Yeah.
And to everybody's wife, right? But so here's the point of this, Josh. That's the demographics. When I was 25, wasn't no plan of having a couple of car leases, a mortgage, and a lot of insurance.
You weren't spending the way that you were 2 years later.
Fast forward, I meet Patty, and the game is on. We have two boys, and we move out to the burbs.
And
that's this chart.
Now you're spending for 4.
Now you're spending for 4, but you're spending differently. Remember, the millennials were always going to take Uber. They were never going to move out of the cities.
Right. It was
the dumbest thing I've ever heard in my life.
Endless MDMA fueled brunch.
There's not enough cars. There's not enough houses for us.
Do you know what's as dumb as that? That you're going to retire. You guys are money managers for people.
Yeah.
You're going to retire at 62 to 65. You're going to live 30 years.
Yeah, I'm not retiring.
On like a total of
I'm trying to get Barry to even discuss. Barry just turned 60. He won't even discuss retirement. So I don't think I'm retiring.
You don't want him to get bored.
No, I joke with him. No. So this chart is showing the number of millennials turning 30.
Right.
Suggests household formation spending and investment can continue. So this is a boom in people born in 1990.
No, it will continue.
Which they just turned 30.
Not can. It definitely will.
It has to.
Yeah. It has to.
It has. But what do you need for that? You need lower interest rates to afford the higher houses. You need
more houses,
other stuff.
More houses.
You know that comes after the kids that are grown up, right? So.
No, but we have a shortage of houses.
Oh, we absolutely.
Yeah.
I mean, Ivy Zellman, you should have her on. I call her the queen of home building. She's fantastic.
Wait, I'm sorry. Did we just speak about this S&P with EPS chart? Can we just throw something one more time?
Sure.
This is very simple. Stocks actually represent ownerships of businesses. I know like we just trade them on the screen, whatever. Like they actually represent ownerships of businesses. And where earnings go, the price of stocks follow. It's very simple.
Michael, I swear to God, the problem became for me in this business and I've worked at NASDAQ over-the-counter firms, when people started trading symbols instead of what it was intended for. Which
That's my generation.
You want to buy a piece of business. Well, mine too, honestly.
Like we don't even, when I was like 23, 24, we stopped even calling these companies by their names. We started referencing them as symbols.
That's it. And I remember, when I used
JDSU was the company. JDS Uniphase can kiss my ass.
Our friend Joe Fami tells the best story ever about the late 90s. He tells his friend, he's like, dude, that biotech. He goes, that's a biotech? Oh, okay.
That's right, exactly. So this chart, the reason it's so important, I've made so many mistakes in my life and career. Right, I still make them. So when people do, I got you. It's the dumbest. It's just awful because, of course,
we know awful people.
So what I've learned in those mistakes is the core thesis. Here's the core thesis in a nutshell. The fact is, the market moves with the direction of earnings. It's not debatable. That's a fact, right? Look at it. You don't need to be a master market guy.
Does one peak before the other historically?
I don't even. They move together. It's a non. It can, but it's not led. I don't want to optimize it.
If profits are growing, stock prices historically are,
and that's what's
growing.
happened. And it's not serial correlation, which means they always move up. Right? You can see that when earnings go down, stocks go down.
And look at this chart. Very clear.
So that's the core
if you had to show somebody one chart.
This is it. But there's 4 other points. So the market moves with the direction of earnings. Well, what drives earnings? Economic activity.
What drives that?
What drives economic activity? Money, availability.
Yeah.
Right? What drives that? Fed policy. And what drives that? They told us. Core inflation and unemployment. It's not science. It's not. It's. Those are. So every time I get stupid and make a bad call,
meaning
it's always because I'm not
that framework.
Correct.
Okay.
So I've tried since we've known each other as well as we have. I've tried to not deviate from that, as painful as it can be.
Because there's always this fifth thing, like Russia invades Ukraine.
Correct.
Or China is saber rattling over Taiwan. There's always this other thing.
Property values, property companies in China are
national debt. There's always that other thing in the back of your head.
It always comes down. I have another chart. I hope John can bring it up. It's money availability. It's an excess liquidity chart. It's a real. This is liquidity.
Yeah. What are we looking at here?
All right. So people look at money
go backwards
supply.
To find that one.
Yeah.
We have that higher in the doc.
Yeah. Money supply. Everybody looks at, and it grew at a level that's never been seen before at 24%. What I like to look at
1 year, money supply exploded by 24% in 1 year.
Right. So here's what happens.
Is this it?
No, this is not money supply. This is real liquidity, which takes money supply growth plus a very key component, guys. Equity and bond, mutual funds, and ETFs. Readily available money. Money you can go to
can be sold and used
in a day. Right.
Yeah.
Why are we then taking out industrial production?
No, because that's what's being used for economic activity. Real liquidity is what you have versus what you need to spend. So on a household level, it's utilities and cable and things like that, right? And real liquidity, it's what you have readily available versus what's being used for economic activity. So as you'll see in 2003, a never before seen spike, right? In 2008 and into early 2009, again, a new high in excess liquidity. And look at what we did this time. We kept it there for 2 years.
And it's double the size of the prior peak.
It's double the size. So if you look at how high that 30% is relative to the prior peak, that's drawn because of this cycle.
What is the message,
It looked the same last cycle.
So what happens as it reverses?
We're doing what we do normally. When it comes down, it just means you're putting the money into economic use. It's a good thing.
Yeah. Okay.
It's not that money's going away or it's tightening. It's being used by companies. If you do a $1 billion bond offering, right? If you're a company, CFO doesn't put it to use in the first day. They put it in a bank. Remember the reverse repo stuff?
Yeah.
That was getting everybody crazy?
Yeah, late 19.
The only reason that was even after this, because that surge in excess liquidity and money supply, you do a bond offering, you got to put the money in a bank. Where are you going to put it?
Yeah.
If you're a company, you raise $500 million in a bond offering.
Yeah, you got to put it somewhere. If you're not using it all at once, then it's got to sit
and
somewhere.
You're not going into futures.
Right.
You're going to put it in a guarantee. You're going to put it in short-term T-bills.
Right.
Right,
Okay.
and that is a really big deal.
So that wasn't a lack of liquidity. That was just money waiting to be something to be done with.
Forced into T-bills, and they're not. Here's another one that nobody talks about. Right? How about this one? Thank God the Fed's tapering, because if they hadn't started tapering, they would have bought all the bonds. In 2018, when quantitative rates were rising, quantitative tightening, you had $1 trillion tax cut. You were funding it with production of treasury bills. Increased not just treasury bills, but treasuries, government paper. So you were letting stuff roll off the balance sheet at the same time as having a massive increase in supply to fund the tax cut. Today, it's opposite. The Treasuries put out in the last 2 quarters a statement saying they're producing less Treasuries because there's no need because there's a stimulus. So when you're buying less paper, it's neutralized because you're producing less paper.
Right.
And when you go into QT, you're not fighting increased supply.
Right.
So how does that stuff impact earnings? Because if we're saying that earnings drive stocks, how does that stuff impact earnings?
It's all about money availability. So what level of rates is the most important? It goes back to
what is it? Is it Fed funds?
So banks are now getting their money. They initially get it at the deposit rate. So I have 2 yield curves you look at. In the beginning of a cycle, it's the deposit rate or 3-month against the 5-year, your average duration. right? That's the right one to look at. It's the cost.
3 month to 5 year versus 2s and 10s, which is what everyone else
looks like 3 and 5.
And 2s and 10s you use when they – so after the bank earnings, my friend Brian Reynolds, who's one of my credit guys, he pointed out that the top – I think it was 4 banks, Goldman, Bank of New York –
SoFi.
A couple other – that's like me, a shameless plug, dwyerstrategy.com. So anyway, when you look at those banks, they raised, I believe it was $28 billion in corporate credit in a week. So now they're raising money in the market. Now you use the 210.
Right.
Because they're getting their money in the market in a duration. In the beginning of a cycle, they get it by the deposit rate. In the middle part of the cycle and beyond, they get it in the open market, so you use a different yield curve.
Let's go to corporate credit real quick.
Sure.
I think this is from Tracy Alloway. She did this
Throw
post.
this doubts about debt chart up, John. Black chart. Measures of corporate credit risk have jumped recently.
If we were to zoom out, this is really, it's nothing with nothing, but it is noteworthy that finally this is starting to hit the credit market, the equity volatility that we've seen. But the next chart I think is more interesting. Almost always, and this is only going back 5 years, but almost always stocks get hit harder than bonds. I mean, stating the very obvious. In the most recent drawdown, at least for the S&P, investment grade credit had a lower drawdown than stocks, or at least where they are today.
It was very interesting because the last time I looked at a couple of ETFs in the investment grade credit, and the last time you had a 20-day rate of change that was in the yield outside of a recession
2013?
was taper tantrum.
Yeah.
And by the way, that was a
great buying opportunity.
That was a great buying
Is
opportunity.
this just normalization?
For bonds.
Is this spike in the corporate credit risk? Isn't this just getting us back to normalization? Like there should be bankruptcies.
Yeah. If you look back, I think I had included. I don't know if I included that. Sure. If you look at corporate credit, Josh,
Yeah.
they do this. You have in 2005 and 2011 you had a spike in corporate credit yields because you were in this transition of Fed policy that you didn't know how it would. It's the uncertainty.
Yeah, you don't know how long the hiking is
Well,
going to
by the
go
way,
on for.
Josh and I was talking about this yesterday. Bank of America put out a chart showing all the corporate cash on balance sheets that they've already gorged, and so they could withstand higher rates because they're already flush with
They've
cash.
got yield. They got years.
It's $19 trillion in cash on consumer balance sheets.
So if
plus
rates go up,
corporate
they're
cash.
good.
What do you think is going to happen to the buybacks? It's a historic level. Again, my buddy Brian Reynolds tracks it. It's a historic level of buyback announcements because you are flush with cash.
Yeah.
You don't go into recession when you have too much money.
And there's a limit to how you could even invest that cash productively outside of buybacks.
Yeah.
It's not that many things that you can really do.
By now, a lot of the strategic acquisitions have happened because interest rates were so low. You just tapped the corporate
All right,
bond market.
so Tony, sum up for the listeners. And obviously, this is always subject to change, and we'll have you back on. But how you're feeling now? Like, sum up your just like view of what's going on and whether or not so far. It sounds like you're saying so far most of what we're experiencing is highly predictable of what it looks like after you've come out of a recession,
and it just doesn't feel like it.
Okay,
right?
Why? Because the numbers are so big.
Because the numbers are so big, and. Buddy, we're inundated with information every day, and we're both on TV, right? And it makes you feel like I love the line, don't just sit there, do something.
Yeah, sure.
I have the opposite line right now. Don't just do something, sit there.
All right, so with that being said, what would you tell our listeners? Stocks going up tomorrow? Stocks going up tomorrow?
Yeah, give everybody listening individual advice.
Yeah, right now.
What I want to do is I've said, let's avoid a catastrophic mistake in this time frame. And what that is puking into the kind of whoosh we saw a couple of weeks ago. Or buying
whoosh
into
lower.
a spike, right? A whoosh lower.
Yeah.
Like we have 4 key tactical indicators we watch, but I don't want to buy into a spike because I don't know what the Fed's going to do. I want to see what they say in March. I would rather add exposure at a higher price with better data, so that when it goes against me, I don't care. I think what you've been very good at, Josh, is having a rational thought when things are going against you because you have a process and a plan that you believe in. You have information you believe in.
Well, also making these decisions in advance of what we're going to do and what we're not going to do rather than during.
That's
extremely helpful.
Point. That's my point. So don't just do something, sit there.
Tony, if we were able to raise interest rates 4 or 5 times this year to get off zero and normalize the monetary situation and the stock market were to deliver flat to up or down 5%.
That's my call for the
Isn't
year.
that a great year?
That's a great year.
Like just for society. Like,
so think about this. You've added trillions of dollars. You've increased prices of homes 40, 50%. The economy cannot withstand significantly higher rates. The 10-year bond yield at under 2% is screaming at us that it cannot withstand higher rates.
Right.
And so if you bring, that's why, if you remember that Fed funds chart, that's why it's a lower peak each cycle. Because there's so much more debt, it's so much higher
Michael
prices.
also makes this point. There's so much demand for 10-year treasuries.
Yeah.
Anytime they get near 2%, there are a lot of buyers.
I would be very surprised
How
if we
can
get
you
meaningfully higher.
possibly get if you're a pension plan or an endowment and you need a 7% return and stocks give you 7%, but you're 60% in bonds, and the highest category of fixed income that's liquid is high yield is giving you 5%.
Yeah.
It doesn't work so what do? You put it all in private equity.
Yeah.
So you have a money flow.
They could at least promise you 12%.
Guaranteed.